Welcome to this explainer. Listen, if you've been following the markets lately, you already know that literally everyone is talking about Nvidia, Microsoft, and all the usual mega-cap AI darlings. But today, we're going to look right past that spotlight. We are diving deep into the hidden fundamental infrastructure stocks that are actually making this entire artificial intelligence revolution physically possible. These are the unsung heroes of the AI tech stack, and honestly, they're hiding right in plain sight. Okay, let's dive into this. Here is our roadmap for today. We're starting with the hidden ecosystem, then moving to the server powerhouse. After that, custom silicon, the connectivity fabric, power and manufacturing, and we'll wrap it all up with portfolio building. Let's get to it. Section 1. The hidden ecosystem, beyond the usual AI darlings. So while the big software giants are grabbing all the headlines right now, massive physical data centers are where the real heavy lifting happens. It's like a giant puzzle. On one side, you've got the spotlight, those pure-play AI stocks and hyperscalers that are trading at these lofty 50 to 100 times forward earnings multiples, which, let's be real, is largely driven by hype. But on the flip side, you have the enablers. These are solid infrastructure companies listed on major exchanges like the NASDAQ and NYC. They give you liquidity, transparency, and way more grounded valuations, usually sitting comfortably in that 20 to 30 times PE range. These are the guys driven by real fundamentals and actual hardware delivery. Think about these AI enablers kind of like the California gold rush. Back then, the people who consistently built the most sustainable wealth weren't necessarily the ones out there panning for gold in the rivers. No, they were the merchants selling the picks and the shovels. In today's AI revolution, our picks and shovels are the foundational physical hardware. I'm talking about the servers, the power management systems, and the crucial connectivity required to build the massive data centers that make generative AI actually work. Section 2. The server powerhouse, Dell Technologies. Now, we really need to stop thinking of Dell as just some legacy PC company, because they are an absolute powerhouse in high-performance computing infrastructure. Just look at this number, 757%. In its fiscal first quarter of 2027, which ended in May 2026, Dell's AI-optimized server revenue alone hit a massive $16.1 billion. That is a staggering 757% year-over-year growth. They aren't just tagging along for the AI boom, they are literally a central engine of it, shipping these high-performance systems at an unbelievable scale. And this brilliantly illustrates that this explosive growth is absolutely not a one-off fluke. The previous quarter already showed a highly impressive 342% growth, but jumping up to 757%, that shows us momentum is accelerating dramatically. Hyperscaler demand for these super complex workloads is just surging right now, and Dell's end-to-end solutions are perfectly positioned to capture it all. What's really compelling here, though, is the valuation. With Dell, you're looking at a forward PE of around 22. Compare that to those pure-play AI names we talked about at 50 to 100 times. Plus, Dell actually pays a dividend. They recently bumped their quarterly dividend up by 20%, bringing the annual payout to roughly $2.52, which yields about 0.6%. With earnings per share projected to grow over 50%, this represents a deeply grounded entry point for anyone looking for that sweet spot of growth plus income. Section 3. Custom Silicon, Marvell Technology. Okay, we're zooming in now, from the massive server racks right down to the actual chips. Marvell handles the vital flow of data. Think of them as the nervous system of this whole AI build-out. It starts with Marvell designing custom AI chips tailored specifically to a client's needs. By swapping out off-the-shelf chips for custom silicon, Marvell creates highly sticky, high-margin revenue streams. That data then flows through rack-scale connectivity before finally getting to the hyperscaler for deployment. So Marvell's role here is just absolutely foundational. Specifically, Marvell is bringing some insane innovations to the table, like their massive 102.4 terabits per second switch and advanced silicon photonics. Now, because they are sitting right in the middle of a multi-trillion-dollar opportunity, their trailing PE sits around 57. And yeah, I know that multiple is elevated, but it is heavily justified by the triple-digit data center revenue growth they're pulling in, which is totally driven by these AI-specific silicon and optics solutions. Plus, they also offer a modest dividend, which is a nice little bonus. Section 4. Connectivity Fabric, Astero Labs. So the crucial point is, if Marvell provides the nervous system, Astero Labs provides the high-speed highways. As this quote perfectly captures, Aster is quite literally becoming the fabric of the AI factory. You see, as GPU clusters get denser and more complex, they demand an unbelievable amount of connectivity. Astra solves this huge bottleneck with their Scorpio fabric switches and optical connectivity solutions. They are completely unblocking the data flow within these next-generation racks. And the market is definitely rewarding them for it. In their Q1 2026, Astra saw a massive revenue surge of 93% year over year, hitting $308 million with very strong gross margins. Now, keep in mind, they don't pay a dividend yet, they're heavily reinvesting in their own growth right now, and they do carry some customer concentration risk. But if you're an investor looking for pure AI upside, the validation they're getting from major hyperscalers is incredibly encouraging. Section 5. Power and Manufacturing, on Semiconductor and Jabil. Let's zoom back out to the macro necessities for a second, because you simply cannot run these massive data centers without incredible amounts of power. And this stat, it's mind-blowing. Previously, a server rack might need just a few $1,000s in power tech. Today, every single next-generation AI rack requires over $100,000 in power management silicon. That is a massive leap. And it's a huge tailwind for ON Semiconductor. Their analog and power technologies are absolutely vital for energy-efficient data centers, which perfectly positions their stock for significant re-rating. And then there's Jabil. They are the unsung necessity of electronics manufacturing. Someone actually has to physically put all this infrastructure together, right? Jabil's intelligent infrastructure segment is growing at over 50%, and they just raised their fiscal 2026 AI revenue guidance to over $13 billion. Plus, they're trading at a highly reasonable forward PE of 26 to 30 times. They execute strong stock buybacks, and they offer a consistent, albeit small, 0.09% dividend yield. Behind the scenes, they are a true stable compounder. Section 6. Portfolio Building, Synthesizing the AI Infrastructure Stack. All right, we've covered a ton of ground today, from the massive computing servers all the way down to the assembly line. Synthesizing this stack into an actionable strategy really gives us a clear picture. We've got Dell dominating servers with a dividend, Marvell owning custom silicon, also paying a dividend, Astera providing that absolutely crucial connectivity for high growth, ON Semiconductor managing the massive power requirements, and Jabil assembling it all while offering a small dividend yield. The big takeaway here is that you can absolutely capture the explosive upside of AI capital expenditure growth while simultaneously securing income and grounded fundamentals. You really don't have to choose just one or the other. Now, of course, as with any sector, we have to step back and look at the full picture impartially. There are core market risks you need to consider. Geopolitical tensions heavily impact semiconductor supply chains, for sure. There's also always the risk that hyperscalers might temporarily pause these massive spending sprees. Sector competition is exceptionally fierce right now, and if growth slows down, those elevated multiples we talked about could definitely face valuation compression. This is exactly why position sizing and dollar cost averaging remain absolutely vital tools for any disciplined investor. So I'll leave you with this provocative question to think about. Is your portfolio merely riding the AI hype, or are you actually owning the physical AI infrastructure? By looking past the mega caps, you uncover the fundamental enablers that make this entire revolution tick. Thank you so much for joining me on this explainer today. I highly encourage you to dive deeper into these companies' fundamentals, and as always, remember to consult a financial advisor as you build out your strategy. Keep learning, keep exploring, and I'll catch you next time.